A ceasefire deal nobody expected just hit the wires, and the dollar is in genuine freefall. But here is the twist that will separate the winners from the liquidated. Australian CPI data came in soft, which should be bearish for the Aussie. Instead, Australian dollar to US dollar is ripping higher, and that divergence is a massive trap designed to shake out weak hands and destroy retail shorts. There is one danger zone and one hidden opportunity right now. I will show you both. Stay to the end because I am giving you 3 exact levels you can execute on tomorrow, including the sniper entry that could capture the next 80 pip leg before the herd even realizes what happened. Alright, let us get straight to the instant market verdict. Today's session bias is unequivocally trending higher. Every single time frame, from the 1 hour up to the monthly chart, is printing a strong buy signal. The single invalidation level that flips the entire bullish structure and forces a full reset of your bias is 0.7116. Write this number down. If the Aussie dollar closes below 0.7116 on a daily candle, the uptrend is broken, and we will flip short immediately. As long as price holds above that magnetic floor, every dip is a buying opportunity and every bounce will accelerate. Now, here is the micro insight on where the herd is positioned and why it matters for your trade. Retail sentiment across multiple brokers is showing more than 65% of traders are short AUD. USD right now. They are staring at that resistance level at 0.7216, calling it a triple top, piling into sell orders, convinced that soft inflation will kill the rally. The herd is positioned dead wrong. When that level breaks, the short squeeze will not be a gentle melt-up, it will be a face-ripping liquidation event that sends this pair vertical. Understanding the trap is what gives you the edge. Let us walk the charts from the top down, because the technical structure is screaming something that most chart watchers are completely missing. Start on the weekly time frame. The 200-week moving average sits all the way down at 0.6872, nearly 1,000 pips below current price. That tells you the secular, multi-year bull trend has never been healthier. The weekly strong buy is not just a label, it is confirmed by a ladder of rising moving averages. The 20-week, 50-week, and 100-week all slope upward in perfect alignment. This is institutional flow building a base that will support a multi-month run, now drop down to the daily chart. The moving average picture is a textbook bullish continuation setup. The 50-day moving average at 0.7129 has been acting as a dynamic springboard for 3 consecutive tests. The 20-day moving average at 0.7168 has just recaptured the 5 and 10, and price is comfortably above all of them. There is zero overbought condition. The daily RSI is sitting at 53, right in the middle of the range, giving this rally enormous room to breathe before it even approaches exhaustion. The MACD on the daily has turned positive at 0.001 after a prolonged period of compression, confirming that momentum is flipping from neutral to bullish. This is not a noisy crossover, it is the beginning of a fresh impulse wave. Here is what most traders miss, and this is where the 3-minute retention bridge hits. Go down to the 4-hour chart. In almost every triple top resistance test, you see bearish RSI divergence. Price makes equal highs while momentum fades. That is exactly what retail is banking on. But there is none. Look at the 4-hour RSI. It is making higher lows along with price. The MACD on the 4-hour is printing a higher low as well. This is hidden bullish confirmation. The market is absorbing every sell order at 0.7216 without breaking a sweat. Every time price tags that level, the pullback gets shallower. This is a classic coiling pattern that explodes in the direction of the dominant trend. The dominant trend is up. The next signal changes everything. If we get a 4-hour close above 0.7216, the breakout is alive, and the measured move based on the range projects straight to 0.7350 let us pinpoint the daily support and resistance levels with absolute precision. Daily resistance sits exactly at 0.721. 6. The level that has capped price 3 times. Above that, the next structural resistance is 0.7262, which was the February high. Beyond that, the liquidity void opens up to 0.7320 and then the measured move. On the support side, 0.7116 is the invalidation pivot. This was the breakout point from the prior consolidation range. Immediately above that, the 50-day moving average cluster around 0.7129 adds a secondary magnetic floor. Below that, the next line in the sand is 0.7070, which coincides with the 100-day moving average and a major swing low. If we lose 0.7070, the dollar has staged a major reversal. Until then, every higher low is a gift. Now let me connect the China proxy thread, because the Australian dollar is not just a currency pair, it is the world's most liquid real-time barometer of Chinese economic momentum and global risk appetite. Iron ore futures have been grinding higher for 4 consecutive sessions on the Dalian exchange. Copper is catching a bid, and the Australian-Chinese trade data for industrial metals is quietly improving. With the US-Iran ceasefire extension deal removing a huge geopolitical risk premium from crude oil and dollar safe havens, the risk-on floodgates have opened. The S&P 500 futures are up over 40 handles as I speak, and the Aussie is moving tick for tick with that equity. Melt up. When the VIX is compressing and high beta currencies lead, the China proxy, AUD, outperforms everything. Even the soft Australian CPI is being reinterpreted as bullish, because it buys the RBA time to stay on hold while the Fed faces increasing pressure to cut later this year. The cross-asset linkage confirms this is not a mere dollar story, it is a genuine risk-on reallocation that will drag Australian dollar to US dollar through that ceiling. Now let us anchor this to the core fundamental driver because the news flow is the very trap we are exploiting. In the last 24 hours, the single biggest catalyst was the report that the US and Iran have reached a ceasefire extension deal. The dollar index immediately shed 30 pips, safe haven flows reversed, and commodity currencies scream higher. At the same time, Australia's monthly CPI indicator came in below consensus. Headline inflation decelerated more than expected. Under normal circumstances, that would hammer the Aussie because it reduces the probability of another RBA hike. But the market is looking right through that data. Why? Because the dollar's decline is dominant, and policy divergence has shifted. The Fed is on hold, yet Fed funds futures are pricing a 70% chance of a September rate cut after recent soft US data. Meanwhile, Australian 10-year bond yields are holding their premium over US Treasuries, and real yield spreads are widening in favour of the Aussie. This is the yield differential jet fuel that powers sustained Australian dollar to US dollar rallies. The 1 to 2 week directional lean is clearly to the upside. I am targeting 0.7262 first, then the measured move to 0.7350. The specific event that invalidates this entire thesis is a daily close below 0.7070. If that happens, the dollar has found a structural bottom, and the breakout narrative is dead. But until then, the path of least resistance is a violent squeeze. Let me ask you directly, do you think the Aussie dollar breaks 0.7262 this week? Comment yes or no right now. I am tracking the consensus in real time, and it is going to be fascinating to see how many traders are still trapped in disbelief, fighting the last war. Now we get into the part that separates the spectators from the funded professionals. Most people skip this section. That is exactly where the money is made. Keep watching because I am about to hand you 3 precise trade plans with exact entries, stops, and targets. Do not just listen, screenshot these levels. First, the sniper, the conservative play. This setup waits for unbreakable confirmation of the breakout to avoid the fakeout. The trigger condition is a 1-hour candle close above resistance at 0.7216. So we enter on the very next candle open after that close, roughly 0.7218. The stop loss goes at 0.7185. Just below the prior session's low and the 4-hour 20-period moving average. That gives you a 33 pip stop, tight and defined. Take profit 1 is set at 0.7260, just ahead of the structural resistance so you are not caught in the noise. That alone delivers a 1.7 to 1 risk reward. Take profit 2 is at 0.7320, where the next liquidity cluster sits. That pushes your total return to 3.1R. The setup is entirely void if the daily candle closes back below 0.7180 before the breakout trigger, meaning the market fakes out and we stand aside, capital intact. This is the sniper's edge, patience for the clean trigger, then maximum follow through. Strategy 1. The sniper, conservative, entry, 0.7218, after 1 hour close above 0.7216, stop loss, 0.7185 take profit 1, 0.7260 take profit 2, 0.7320 risk, reward, 1:3.1 are invalidation, void if daily close below 0.7180 next. The active trader setup, perfect for those who want to get involved before the breakout but with structural logic. This is a mean reversion play on the 4-hour chart. The entry condition is a pullback to the 0.7165 zone, which is the confluence of the 10-period moving average, a prior swing low, and the 38% Fibonacci retracement of the latest leg. Wait for a bullish rejection candle, a pin bar or an engulfing candle on the 4-hour time frame. Stop loss goes at 0.7145, below the 50-period moving average. And the intraday demand zone. That is a 20 pip stop, tight but surgically placed. First target is a return to resistance at 0.7216. That is a 51 pip gain, giving you over 2.5 to 1 risk reward right out of the gate. Once that first target is hit, move your stop to break even. The second target is 0.7250, and then trail your stop manually using the 1-hour 20-period moving average to let the position breathe. The invalidation point is a 4-hour close below 0.7145, which would signal that buying pressure has completely evaporated. This is the active trader's plan for capturing the dip before the surge. Type your own Australian dollar to US dollar range for tomorrow in the comments now. High and low precise levels. Let us see who is aligned with institutional flow. Strategy 2. The active trader, standard, entry, 0.7165, bullish 4H candle confirmation, stop loss, 0.7145 take profit 1, 0.7216 take profit 2, 0.7250, trail with 1 HMA20 after TP1, risk, reward, 1:2.5R to TP1 invalidation. Void if 4H candle closes below 0.7145 and now, the aggressor, this is the high risk, momentum chase play for those who can lose small and manage risk aggressively. The entry is right here, right now, at current market price 0.7184. You are front-running the breakout with an extremely tight leash. Stop loss is set at 0.7170, just below the sharp intraday support and the 5-minute order. Flow by zone. That is a 14 pip stop, tiny but deliberate. First target is the resistance at 0.7216, a 32 pip gain, immediately over 2 to 1 risk reward. If we get a strong 1-hour close above 0.7216, the second target opens to 0.7260, and you must tighten your stop to entry. This is a high-octane trade that can get stopped out in a heartbeat if the dollar finds a sudden bid, so only use this if you are comfortable with heat. The setup is invalid if price breaks below 0.7170 before hitting first target. Aggressor plan. Small size, zero hesitation, surgical risk. Warning. Only for those who can accept a quick loss without emotional damage. Strategy 3. The aggressor, high risk, entry, 0.7184, market, stop loss, 0.7170 take profit 1, 0.7216 take profit 2, 0.7260, move SL to BE after TP1, risk, reward, 1:2.3R to TP1 invalidation, void if price trades below 0.7170 risk management pulse, 30 seconds, non-negotiable. Never risk more than 1 to 2% per trade. No open positions through high-impact news events. Hard stops are not a suggestion. They are the only thing that keeps you alive to trade the next melt-up. This is how you survive to capture moves like the one setting up right now. Let us sum it up. The single most critical level for the next session is 0.7116. As long as the Aussie dollar respects that floor, the melt-up towards 0.72. 6.2 and beyond is fully intact. Tomorrow's wildcard is the US ISM manufacturing print, and any further geopolitical headlines that could accelerate or pause the dollar's decline. If the ceasefire narrative holds and risk assets extend, we could see a vertical candle that leaves latecomers chasing price into exhaustion. I am covering the S&P 500 gamma levels and Bitcoin's shocking divergence from tech stocks in the video that is live right now. Tap the end screen and I will walk you through the next domino. If this gave you a clear, actionable plan, smash that like button, subscribe, hit the bell, and I will see you in the next one. Let us capture these pips together.